Remember Express? It was an American mall staple all over the country. The popular retailers raking in $1 billion in annual sales from more than 600 stores in 1991.
The sprawling stores won over young professionals with elevated essentials, and the company went public in 2010.
Clothing retailer Express, ticker EXPR, celebrating with audacity their recent IPO.
They were on the top of people's list in terms of affordable fashion and luxury. They were expanding significantly, and they felt they could do things like have a flagship store in San Francisco, New York City, expand internationally. They're making good money.
But in April 2024, the company filed for bankruptcy.
It wasn't popular anymore, and it didn't make the right changes to win back consumers and become popular once again.
In June 2024, a New York court approved the acquisition of the company by a new joint venture called Phoenix.
So how did Express go from fashion shows in Times Square to closing its Times Square location? And now, as an investor group swoops in to save the brand, could there be another chapter to its story?
In the early aughts, mall presence was everything.
E-commerce wasn't as big of a deal as it is today. They were places where people went to congregate, to do all of their shopping, do entertainment, things like that. And Express's footprint was primarily in malls, so they won a lot of that traffic during that time. And it was also a different time in fashion as well. People went to an office 5 days a week.
In 2011, the company crossed $2 billion in net sales and acquired startup Bonobos in 2013.
In the years that followed its listing on the New York Stock Exchange, the stock price fluctuated, something analysts say is the nature of fashion retailing, where sometimes you miss the mark on trends and styles.
The flip side of fashion is you don't want to have a lot of product. So if it misses, okay, you get rid of it, you move on, you hit the next trend. Express, unfortunately, did not have the controls, and they would miss and have too much inventory. And when that happened, it would take 2 to 3 quarters to clear out the product, and the financial results would lag.
But it's not just about trends or consumer preferences changing. Material prices fluctuate too. Nonetheless, the business continued to grow.
You had Michael Weiss, the CEO, and he was considered this mercurial CEO who knew how to run this business.
We're really not in the commodity business, we're in the fashion business. So although we do have some product that goes for years, those products become a bit of a concern, but not much, because we buy yarn and we buy fabric far in advance.
It's a unique business where you're trying to be fashionable and provide an affordable product. That's a tough thing, and Michael had it really down. And you had significant store growth, you had significant comp growth, and you actually had significant margin growth at the time. So it was kind of a sexy story.
It hit its peak in sales and store count in 2015. That same year, Weiss retired, and it was pretty much downhill from there. Straddling the line of offering high-end products at low prices stopped working.
That's a great bargain for the customer, but it does hurt the ability to drive margins. And that's always been kind of the issue at Express.
This chart shows the gross margins, a strong measure of the company's performance that Express saw over the years. These lines show the margins for some of its competitors like American Eagle, H&M, and Abercrombie & Fitch. Its products were simply less profitable. That majority mall concept also stopped working as traffic decreased. At the same time, office settings are becoming more casual. Athleisure was huge during the pandemic, and it was the opposite of Express's historical offering. This chart shows how retailers like Nike and Lululemon exploded after the initial pandemic crash, whereas Express didn't. Its stock price saw a bit of a rebound in 2021 post-pandemic as people returned to work, but it didn't sustain.
The problem is that you don't need dozens and dozens of suits, you only need a few.
Its issue was primarily top line, which means that its sales were just down. It was making things that people didn't want to buy. It was outside of the trends. Its price point was out of whack with what it was selling, with the quality of its clothes. It wasn't managing to attract and retain that core consumer. And there's also just more competition.
By October of 2023, the company was buried in debt. Express was routinely struggling to pay its vendors on time at the end of 2023 into the beginning of 2024.
It signals issues, especially when there's wild fluctuations in how many days late you are on those vendor terms. And this can be debilitating for a retailer that's already on the edge. Your vendors are critical. They're providing the stuff that you sell. If you're not paying your vendors, they're going to tighten terms.
From 2016 to 2022, the retailer's store count shrunk by about 15%. Although it lowered leasing costs a bit, the remaining storefronts still cost the company hundreds of millions of dollars.
They're probably one of the top 10 or so stores in terms of square footage in most of the malls. They are in terms of the specialty retailing side of it. And that has a very high impact in terms that you have to pay a larger rent.
The New York Stock Exchange requires listed companies to maintain an average global market cap of at least $15 million over a period of 30 consecutive trading days. Here's a chart of Express's market cap value over the past 2 years. You can see it failed to meet standards here, and in March of 2024, it was delisted. The company filed for bankruptcy the following month.
Bankruptcy is a really effective method for retailers to clean up their balance sheet and to actually find a path forward and restructure their businesses because it allows them to get out of leases.
Within a month of being delisted and declaring bankruptcy, Express received a letter of intent from an investor group led by WHP Global. Express announced it was closing 95 stores. On June 14, 2024, the court approved the new joint venture to acquire retail operations of Express. The investor group includes Simon Property Group and Brookfield Properties, two of the largest mall operators.
They own the Express box, and so if they are the owners, then if that store isn't making a lot of money, then it's okay because they can decide to just keep it open. It's not like you have some other extraneous landlord that's going to be requiring rent. It's your own property. So it puts them in a much better, firmer financial footing.
And I would argue that they looked at the cost of having to close those Express stores right now because they're big, and finding 2 or 3 players to fill them probably makes it not worthwhile to get that Express store closed. Obviously, Express still is driving traffic. It still sells $1 billion plus the product. So it's still driving people into the store.
Ultimately, Beater thinks that success going forward is dependent on a couple of key decisions.
I would sit there and use the time as a private company to decide to become either a fast fashion company or a fashion company. I'm going to be a fashion company, cut back on the inventory significantly, sell it for a higher price, realize that while I'm private, I can use that time to kind of change my customer base and move forward that way. If I'm a fast fashion company, stop trying to be the end-all be-all in terms of my customer and focus on price and producing the quality within it. So there's 2 tracks here. That's up to new management to figure out which one, but trying to do both increasingly in this world just doesn't work.